Hello, everybody. I'm Tracy Themes, co-founder of Sophia Financial Group and Sophia Wealth Academy with my business partner, Kamal Basra. We are a full-service financial planning and investment management firm located on Vancouver, BC's west side. Since we opened, we've been dedicated to delivering excellence in professional, holistic investment management and creating a platform for financial inclusion, education, and inspiration. We believe that money is power, the power to create personal peace of mind and the power to make the world a better place. Wise Money Talks is our online education program with the objective to help you gain control over all aspects of your relationship with money. We want you to be the boss of your money and not the other way around. Money, as I'm sure you're learning, is never just about the money. This season in particular, our offerings have been dedicated to building resilience and confidence so you can move forward in your financial life with strength and conviction. I'm so appreciative of our incredible speakers who so willingly share their time, energy, and wisdom with us. They have brought us new ideas and considerable life experience to their teachings. Thank you from both Kamal and I. I'm also grateful to our webinar hosting and marketing teams for managing all those backstage details and everything that goes into presenting these wonderful speakers. And tonight, we have Sophia Financial Group's own Philip Wong. I'm really excited to hear what he has to say. So for now, I'm going to sign off, leaving you in all of their capable hands. Have fun, everybody. And remember, we're here if you need us.
Thanks, Tracy. Hi, my name is Joanne Loze, and I am very excited to be your host for the Wise Money Talks webinar series this year. Before we get started with tonight's presentation with Philip, please take a moment to introduce yourself in the chat function. Tell us your name and where you're joining us from. This webinar is being recorded and will be uploaded to the Sophia Wealth Academy YouTube page, our YouTube channel, within the next week or so. You will receive an email once it goes live. Just as a reminder, if you missed any of our previous webinars, they are all now available on our YouTube channel as well. And feel free to share these links with friends and family members. If you have any questions for Philip, please use the Q&A tool at the bottom of the screen, or you can actually use the chat function, the chat on the sidebar as well. And that way, you can upload your questions at any point throughout the presentation. And if there's something pressing, we can address it right away. But otherwise, you can put them in the Q&A and we'll get to them at the end of the presentation as well. Now, it is my pleasure to introduce tonight's speaker, Philip Wong, who is a portfolio analyst at Sophia Financial Group and responsible for meticulously analyzing strategies for client portfolios and for client service. Before joining Sophia, Philip worked at a hedge fund analyzing economic trends and fixed income investing while leading the client services administration team. Philip earned his Bachelor of Arts degree at UBC, where he majored in mathematics and minored in economics, both very well equipping him for his role today. Fun fact, Philip is also an avid sports enthusiast. As a summer job, Philip worked as a boxing trainer at a local boxing club, and he also captained 2 intramural volleyball teams to championships while he was a student at UBC. And now, without further ado, I am happy to pass you over to Philip, who will break down financial fundamentals specifically tailored for young people. Over to you, Philip.
Thank you all for being here, and a big thank you to the people at Sophia Wealth Academy for setting all of this up behind the scenes. And thank you for those of you watching at home for giving me the time to be here today. I really appreciate it, and I promise to do my best to make sure that you get something out of this tonight. So my objective is to leave you in control of your financial future. By asking ourselves 5 key questions and answering them honestly, with integrity, and with good intent, together we will build a framework to understand how our daily decisions build our net worth. Now, one key distinction I want to make here is that for our purposes, When I use the term net worth, I am only talking about money and finances. Money doesn't determine your net worth as a person. It doesn't even come close. We can't put a dollar value on our values, our identities, our social circles, our beliefs, or the people in our lives. And one more thing I want to acknowledge is that about everyone in this call, you are unique. We all come from different backgrounds. We have different stories, different financial situations, and we all have different goals and different ideas of success. And that's why the most important component to making your financial plan work for you is you. Now, I want to begin with a quick poll just to get a sense of who you are as an audience, what's important to you. What are you currently saving for? Are you saving for A, living expenses, things like rent, groceries, or utilities? B, are you saving to have a little bit of fun? Things like clothes, cars, vacations with friends. C, are you saving for an investment in yourself, something like post-secondary education? Or D, are you saving for a home, a down payment on a home? So go ahead, a pop-up should have come up on your window right there, and just select what's important to you. Now, one thing I want to make sure is that you're not in class. You're not being graded. I'm not your teacher in a university or a school. You're practically anonymous, and there are literally no wrong answers. So I really want to encourage you today to share your perspectives during our time together, because you see the world differently from me or anyone else in this room, and your opinion has value. So the results have just come in. 60% of you are saving for living expenses, things like rent, groceries, and utilities, and 40% are saving just to have a little bit of fun. Thank you very much. Now, another question I have for you is, why are you here? And I don't mean, why are you here in this chat with me right now? I mean, what are you looking to gain? Are you learning how to, A, learn how to build wealth, B, learn financial terminology, C, learn how to get out of debt, D, all of the above, or E, and I have a feeling 70% of you might be in this category, my parents made me be here today. So again, go ahead and just knock out one of those selections over there. So 50% of you are looking to learn how to build wealth. 33% of you have selected all of the above, and 17% of you are here because your parents made you. Well, either way, congratulations. Let's start getting into the meat of the presentation right now. What is money to you? We've all held money. We use it every single day, but our perception of what money is so different between all of us. Do you love it? Do you hate it? What do you think about when you think about money? Do you imagine a Ferrari? Do you think of gold teeth? Is it a number in your bank account? Is it for a common good? Is it to pass on? Is it for donations, to eliminate all suffering? Just let us know in the comments below. I'd love to read them as we go through this presentation. Now, in your generation, and I'm talking about 16 to 25-year-olds here, not the rest of you pretending to be in your 20s like me, you are spoon-fed a specific perception of what money is every single day of your life. As soon as you turn on your social media, your Facebook, your Instagram, your TikTok, Snapchat, whatever it is, you are fed posts of people showing off their money and wealth. They're on vacation, they're eating at the best restaurants, they got a new watch. I call this getting flexed on. Think about how many posts you see every single day of people constantly flexing on you. One friend posts about a new pair of designer shoes. Another friend just got a new car. Someone you don't really like's on vacation. A celebrity posts about drinking champagne in a private villa. And here we are sitting on the toilet, liking every post that goes by. Everyone you see on that small little screen is living the good life, and abundance is abundant. You even hear it in music too. Rap is all about having it and flexing it. Some rappers take it so far to even name themselves after their aspirations, like Radic Davis, who goes by his stage name Gucci Man. Tawheed Epps calls himself 2 Chainz. The humble ones, like Curtis Jackson, even calls himself 50 Cent. The lyrics are all about wealth, and they simply have it all, and we don't. But they're flexing. We're all constantly getting flexed on because people love showing off. Imagine if someone followed you every day just to show off their muscles. You would tell him or her to get lost, go get a job, and go leave me alone. And yet, we're drawn to this kind of financial flexing. And by the way, not only is our culture and economy based on spending, the psychology and technological algorithms behind targeted advertising based on your viewing history gives us little to no chance to save and build wealth without intervention. Companies invest billions and billions of dollars to find out exactly what makes you spend and when. So maybe I can share my own story. Last year, I had an impulse to buy a brand new pair of portable speakers. I looked them up on Best Buy, but I decided against it at the moment. But for the next 2 weeks, I couldn't escape the ads for these speakers. It didn't matter what website I was on, whether I was reading financial news or on social media or Reddit or sports news, the ads for these speakers followed me around like a ghost, always tempting me to give in to my temptations. And I'm here to tell you, it worked. I gave in, I bought the speakers, I clicked 3 buttons and the order was on the way. And there's a nice big button that says add to cart. My credit card info, it was already saved on my computer, so I didn't even have to type anything in. I didn't have a chance to walk away and grab my wallet and think about it. I got an email confirmation that for the order and another email telling me that it's been shipped. I tracked it like an addict, and it arrived at my doorstep within 3 days, wrapped up like Christmas morning. It was such a rush, and I couldn't think about anything else. But I can tell you today that it was not the best decision for me because 1, I didn't actually need it. As soon as the spending rush was over, it just became another object in my room taking up space. And number 2, I built onto a bad habit. Giving into our impulses creates a behavioral cycle that becomes harder and harder to break each time we give in. And I'm not ashamed to admit that when I was younger, I fell into this trap all the time. I thought money was all about instant gratification, and as soon as it came, it went. I went years without building any net worth because of the quality of decisions I made every day. Basically, my goals and my strategies were just not in sync. But one day, my brother told me something that forever changed how I saw money. He said, and I remember it because it put everything into context for me, people only share their highlights, but they never share their lowlights. That's what you see on social media all the time. Highlight reels one after another. Social media disillusions us from what money really is. The latest trend in investing is literally called meme stock investing, where companies like GameStop and cryptocurrencies are taken off like never before. Oops, sorry about that. Are taken off like never before, and everyone you follow and read about, they're getting rich quick, and you're missing out. So I want to put this all in the context for you. I have a question for you. If you can put it down in the chat. If you received $10 million today, what would you do with it? Now, again, we're all different. We all come from different backgrounds. We have different stories. So how you use this 10 million is different from how another person would use that 10 million. Put it on in the comments. I would love to read it. And I wonder if by the end of this of our talk and time today, I wonder if your answer would be different. So let me put all of this in a context for you. This is one of my favorite parts of this presentation. Now, I love sports. And in 2009, Sports Illustrated, a popular magazine, released an article that changed my perception of what money and wealth really is. We all know professional athletes are some of the highest paid professionals in the world. For example, according to Forbes, basketball legend LeBron James made $85.5 million in 2018. In 2019, Forbes reported that Cristiano Ronaldo, legendary football player, made $109 million in 1 year. Now, this is not a small amount of money. Professional athletes should have more than enough to last 5 lifetimes. So let me just pop over here and see what we got. So Madeline, you said that you would invest it. You say about the $10 million. Madeline, you said that you'd invest it, you'd save it, travel, and donate it. I love that. Sandra, you said that you put it in the bank. Very fiscally responsible. Awesome. So my question to you, just back into our topic of sports and money. What percentage of professional athletes do you think go broke in retirement? Is it A, 10%, B, 30%, C, 40%, or D, 50%? Oops, sorry. Just want to make sure that you guys can see the poll and you guys are participating. And what percent of professional athletes do you think go broke in retirement? So we've got C, we've got some answers come in. We've got Joanne thinks it's 40%. Madeline, you think it's 50%. Pablo, you think it's 50%. A lot of answers are coming in 50%. This is what Sports Illustrated reported. You guys are correct. 2 years in retirement, 80% of retired NFL players, National Football League players, were bankrupt or faced financial difficulties. 5 years into retirement, 60% of retired NBA players were bankrupt or faced financial difficulties. Think about that. These athletes are some of the highest paid in the world. They'll make more money than most of us will ever make, but they still go broke. Over 60% of professional athletes go bankrupt in retirement. It's a shocking statistic because it shows that it doesn't matter how much money you make. Humans, people, you and I are creatures of habit, and when given the opportunity, we'll always adjust our lifestyles upwards to find a way to spend. Now, I present to you the idea, the concept that money is a tool, and for the rest of your life, you will have a relationship with money. Now, just like all relationships, there are good relationships and there are bad relationships. And when it comes to money, the good news is that it's up to you. So where did our local sports heroes go wrong? And how can you do more with less? These are the 5 critical questions that you have to ask yourself to build your financial plan. Number 1, where am I now? Number 2, do I have a cash reserve? Number 3, where am I headed? Number 4, how do I get there? And number 5, how do I stay on track? Now, the rest of the presentation is all about diving into these questions. So if you haven't written them down right away, don't worry, we're going to spend a lot of time going through this. Let's start with question number 1. Where am I now? Now take a deep breath in and take a deep breath out. For some of us, this might be a tricky question to answer. No, I'm not talking about what room you're in, Mom, that's not funny. I'm talking about financially. Be kind to yourself because you can answer this question without the self-judgment or the cringe. I know that it's not easy to answer, and I won't be calling on anyone publicly to answer this, but the reason that it's important is because you need to understand where you are in order to get to where you want to go. Just like Google Maps, you need to enter your location for it to give you directions to your destination. And again, remember what we established in the beginning. We all have different backgrounds. We all have different financial situations. We have different goals and different and unique perceptions of the world, which drive our needs and wants. The question, where am I now? It doesn't have to be scary. It can instead be asked out of curiosity. So, oops, sorry, jump again over here. So let me help you with this question. There are two parts. What is my cash flow and what is my net worth? Cash flow is simple. There are two parts of cash flow. There's cash flow in, which is how much money is coming into your pocket. You might be on an allowance from your parents. You might have a summer job. You might be working full time. Maybe you have some income from your investments. In all cases, your sources of income make up your cash flow in. Now, your cash flow out is your spending. Things like food, like rent. Maybe some of you have a mortgage. And the total of cash flow in minus cash flow out determines whether you're building or losing net worth. If you have a surplus, well, that's good news because you have more money coming in than money going out. If you have a deficit, it means that you have more money going out than money coming in. And every decision that we make impacts our cash flow. For example, should I buy this coffee and eat out or should I save? The good news is that you have complete control on your cash flow. That's called budgeting. And when we think about budgeting, it's often negative. Your parents might say, I'm giving you a budget of $50 a week. Budgets may seem like they're constricting. They're holding us back and they're making us suffer. But instead, we can think of a budget like managing cash flow, the flow of money in and out. Try to change the way you perceive the word budget and think of it instead as managing your cash flow. And there are a lot of things that you can do to budget or manage your cash flow. And the first step is to understand how you spend. Tracking your expenses on every single thing will have a huge impact on your understanding of your personal decision making and its effects on your cash flow. To be successful, we need to be conscious of where our money goes. You can track this using apps like Mint, that's M-I-N-T, or you can use an Excel spreadsheet, or you can simply write it down with a pen and paper. The important thing is that you can account for every single decision you make when it comes to how you use your money. For myself, at the end of each month, when it's time to review my spending, I go through my expenses on my RBC banking app, which has a great analysis on how I spend. It even recommends budgets on how much to spend when going out, for groceries, for things like transportation, and for entertainment as well. So tracking your expenses is a window into your habits. For example, I love to cook and I like to spend money on food and high quality groceries. But after a while of tracking my spending, the numbers were just shocking. They didn't make sense. I thought I was wrong. There was an extra zero. I thought that I had been hacked by some steak-loving, wine-sipping thief halfway around the world. But it turns out, and I wonder if a lot of you can relate to this, it turns out that the past me was stealing from the present me, and the present me is looking to steal from the future me and his net worth. I'll just let him deal with it. He's a sucker anyway. He's easily fooled. It's his problem, not mine. But the biggest outcome in tracking our cash flow is that it wakes us up to our habits. So now that we've talked about the importance of cash flow, let's move on to the next part of answering the question, where am I now? with understanding net worth. But before we get there, just another questionnaire for you. Where do you think your cash flow is now? Just pop it down in the Q&A section, right in the chat box. Do you think it's A, or do you think it's A positive, or do you think it's B negative? Where do you think your cash flow is now? And again, this is all very anonymous. There's no way for me to ever find out who you are, except for the name that you have here. Excellent. There are a lot of financially responsible people here. A lot of positives, one negative, two negatives, but that's okay. So if you're here, it means that you're committed to building your own net worth. You're here to be responsible, to be accountable, to be a model citizen, and to be in control. Or your parents have forced you. Either way, congratulations. It's the first step forward, and you should feel proud about yourself. And I'm proud and thankful for you to be here because I'm lucky enough to be a part of the commitment that you've made to learn and take control of your financial future. Now, let's understand our financial net worth. As we manage our combined cash flow to turn positive, we get what's called a surplus. A surplus means that we're saving more than we're spending. We have to be comfortable with the idea of having a surplus because that's how we build wealth. You have to build up your ability to handle delayed gratification. For example, I shouldn't have bought those speakers that I did a couple of slides ago when I couldn't afford it. What I should have done is trust myself to know that I can get it in the future on my terms. Now, if you're reactionary to your spending habits, if you can never wait for something, if you don't trust that you'll ever get it in the future, then you will live just like I did, in a moment-by-moment world of immediate rewards without building anything. If this sounds familiar, don't worry, you're not alone. I was there, and I had the same habits. The consequences which I faced was that I never had a surplus, and surplus is required to build our net worth and to become a sophisticated investor. There are people with poor mindsets, never comfortable with excess, and there are people like you with wealthy mindsets. You have to be comfortable with having a surplus. Now, another question I have for you is, what percentage of lottery winners go bankrupt? Do you think it's A, 10%, B, 30%, C, 40%, or D, 50% or more? Well, a lot of D's are coming up here. I think you guys are seeing the connection between people that aren't ready for a huge amount of money and the mismanagement of it. I think we've got about 80% D's over here and 20% C's. Well, according to the U.S. National Endowment for Financial Education, about 70% of people who win a lottery or receive a large windfall go bankrupt within a few years. And the reason they go broke is because they weren't comfortable with having a surplus. They didn't build their financial muscles to delay gratification, and they didn't follow a plan. Spending money, take it from me, spending money is the easiest thing to do in the world. There will always be someone to help you spend it, but very few people in your life will try to help you save it. Now, net worth is everything you own minus everything you owe. Said another way, these are your assets minus your liabilities. So your assets are things like your bank account, your piggy bank at home. Some of you might have investment accounts, or your parents might have set one up for you. An asset is something that holds value and can reasonably be exchanged for money. They also include things like a home, a car, shares of Bitcoin. No, your cheese sandwich isn't a financial asset. Stop trying to sell me your sandwich. When I was a kid, I was into Pokemon cards. And for those of you who live under a rock, Pokemon was the hottest TV show and card trading game for a kid in the 90s. I would work hard to collect them. The TV show's catchphrase was literally "gotta catch 'em all." I would buy them, I would trade them, and my parents were mad at me for spending so much money on these cards, which in their view were just pieces of paper. But 12-year-old me told them, Mom and Dad, they would be worth a lot in the future. It was an investment. They gave me the coldest laugh ever recorded in human history. They refused and made me give up the hobby, and my collection was lost over the years between moving houses and countries. I came from Singapore. My family's from Singapore, of course, and they were mostly lost due to neglect on my part. But today, those same Pokemon cards would have been able to sell in the hundreds and maybe thousands of dollars. They could have been considered a financial asset, but well, Mom and Dad, no one's laughing now. Basically, an asset is anything you can get cash for today or in the future. Now, liabilities, let me go back one slide. Liabilities are the things that you owe, things like credit cards, student debts, mortgages, personal loans or car loans. And so net worth is, again, the total of your assets, the things you own, minus your liabilities, the things that you owe. And your cash flow, if it's a surplus, it builds your assets. And so your net worth is actually the total of every financial decision you've made until now. Now, again, don't feel bad if you're not satisfied with your net worth. That's not the point of our conversation today. By being here today, you're investing the time to learn how to manage your cash flow and build your net worth. You may not be where you want to be today, but it doesn't mean that you won't get there in the future. And remember that everyone is different. And if you one of my favorite quotes, if you try to measure a fish by its ability to climb a tree, it will live its whole life believing it's stupid. Now, you might ask, is it okay to have a negative net worth? And well, there are 3 times when having a negative net worth is actually okay. And these times are 1, if you have a mortgage from a home purchase, 2, you're paying for an education, or 3, you're starting a business, a real legitimate business, not an ice cream stand on the side of the street. In all these situations, having a negative net worth is actually building into a bigger goal. So now that we have an understanding of cash flow and net worth, we are equipped to answer the question, where am I now? So let's go ahead and move on to our next question. Number 2, do I have a cash reserve? Cash reserve is money you've set aside for opportunities and necessities that you can access in less than 1 day. So no, your home isn't a cash reserve. Your stocks are not cash reserves. Your dog isn't a cash reserve. This is just pure cash in your hand or at the bank in high interest savings. We don't want too much cash on hand because cash doesn't earn very much for you, but we need it to take care of unexpected and opportunistic events, as well as the psychological effects that having cash has on us. There is no right amount for how much cash you should have. The amount is entirely decided by you. If you're lucky enough to still be living with your parents, and I think for some of you, I've just shut down that moving out conversation, or if you have a stable job, your cash reserves might not need to be so high. But if your money coming in is irregular and you have a lot of bills to pay, for example, maybe you're an artist and you sell your work, you may find yourself with infrequent sales, so your cash reserves in that situation might need to be a little bit higher. Cash reserves can range anywhere from $500 to $10 million. It really just depends on you. So I have another question for you. What is the minimum in cash reserves that would make you feel comfortable? Now this question isn't asking how much cash do you want to have on hand. It's asking how much is the lowest amount of cash reserves that would make you feel comfortable and help you sleep at night. Is it A, $100, B, $100 to $1,000, C, $1,000 to $3,000, or is it D, $3,000 or more? Go ahead and pop it down in the chat. Pablo, I can see you're looking for C, $1,000 to $3,000. Madeline, you're looking for a D, $3,000 or more. Sandra, you're looking for B, $100 to $1,000. Perfect. I feel like I've just tricked you because you have just set your first financial goal. Congratulations, you played yourself. If you don't have this in your cash reserves at the moment, I want you to build towards it. So back to why having a cash reserve is important. The first reason we need a cash reserve is because of its psychological impact on us. With money set aside, you feel calm. You feel in control, knowing exactly how much you have. It also weighs your spending decisions relative to your cash reserves. You might not be so quick to buy those $300 speakers, for example, if you only had $500 in the bank. $500 in the bank. The second reason is that having cash reserves means you don't need to borrow. You can finance your own life and its opportunities and its unexpected events, because borrowing means interest costs and payments, just like when you use a credit card. And while we're here, let's talk about credit cards. I love that one. When we talk about credit in our day-to-day lives, we think credit means value. Hey, you got credit for taking out the trash. You made the sports team at school. You get credit for an accomplishment. At a bank, when it comes to finances, credit is how much the bank is willing to lend you for your monthly spending. When you use a credit card, you're actually paying with borrowed cash from the bank. And if you can't pay off the full balance at the end of the month, you're paying high amounts in interest. And interest is the cost of borrowing. Credit cards can give the illusion of having more cash than you actually have. It is so easy to mistake credit limit with cash reserves. Credit limit is how much the bank is willing to lend you, is willing to let you borrow. Cash reserves are the actual amount of cash you have saved up. And debits, well, debits sound a lot like debt, which is something that you owe. It sounds like a negative number, but a debit card is actually just a link to your cash reserves at the bank. Instead of bringing cash everywhere you go, you can just keep it at the bank and access it with your debit card. Your spending limit is limited to how much cash you actually have in your bank account. So of course, another question that's coming up, how many credit cards do you have? And again, we're all different. It's not a judgment. It doesn't mean that if you have 3 or more credit cards, you're financially irresponsible. We're all different. So A, is it none? B, is it 1? C, is it 2? Or D, is it 3? Or D, is it 3? Of course, that was confusing just to say. I see a lot of 1s. 50% of you say 1. Oh, sorry, 50% of you say none. And then 50% of you are saying 1. And that's the exact same answer that I have as well. I just use 1 credit card because it helps me track all my expenses and spending in one place. I would hate to, in my situation, I would hate to have 2 or 3 or more and not really be able to track that, because I wouldn't be able to control my spending. So maybe your parents gave you your first credit card. Just make sure that you keep within your limits and pay off your balance at the end of each month. Late payments mean more interest costs. Now, some of you might have debt, and it could be credit card debt, university tuition debt, personal debts, and you might ask, should I still have a cash reserve even if I'm trying to pay off this debt? How do I balance the two? There might be high interest costs on your debt, So your rationale is to pay it off immediately and altogether as soon as possible. The problem with doing so is that if you have an issue holding on a surplus and you break your back to get rid of all the debt, once you're done, you might start the cycle all over again. Experts recommend a 1-to-1 ratio of building your cash reserves and paying off your debt until you have the cash reserves that you need. With your cash reserves in place, go ahead and pay off all the remainder of your debt. And again, there are 3 situations when having a negative net worth or carrying debt is okay. Again, those are education, to buy a house, and for starting a business. So now that we've answered the question of where we are by understanding our cash flow and our net worth, and we have established a cash reserve to fund emergencies and opportunities, we now have the privilege of looking ahead. And this is where things get a little bit more fun. Question number 3, where am I headed? So I want to know from you, what are your important goals? Is it A, saving for an education? Again, pop it down in the chat below. B, are you saving for a home? C, are you looking to travel and go on vacation? Or D, are you looking to live fast and die young, baby? B and C is a couple of B and C, saving for a home and traveling. Oh, yeah, more saving for a home and more traveling. Pablo's looking to save for a home. Perfect. And my goal, well, maybe I can just share my goal at this stage of my life is to save for a down payment for a home while living fast and dying young. Now, if you're undecided about your goals, that's completely okay. You could take an inventory of all your wants and needs. You can just go ahead, write them down on a piece of paper and rank them according to importance to you. And I would also love to share if you're willing, just write down some of your goals that I may have missed here in this questionnaire. Again, all in the chat. Now, here are the steps to setting goals and the strategies and how people can fail. Number 1, set a goal. What do you want? What do you want? Is it a new car? Is it a new condo, a university education, to retire in 10 years? What do you want? Most of us can only hold 1 to 3 goals in our heads at any given time. When we add too many, our brains get short-circuited and, our brain got short-circuited, my brain got short-circuited there, trying to prioritize what's important, and we end up not accomplishing anything. We end up compromising one goal for another goal, and we don't actually achieve anything in the long run. So number 1, prioritize what's important to you so that you can focus your energy onto the things that matter to you the most. Remember again, and I can't overemphasize this, we're all different. We all see the world differently. Don't set goals that you think other people want you to set. Set a goal that makes sense for you. There can be a lot of anxiety with setting a goal for yourself, but even asking yourself the question is the first step forward. Now, there's an ancient Chinese proverb that my dad always told me when I was young and living at home. And I believe it's quite relevant to what it's like to achieve a goal. He said, "The journey of 1,000 miles begins with one single step." So go ahead and take out the garbage. By taking on a new goal, we're pushing against the momentum of our daily habits. I believe that change takes 2 weeks of applying for it to stick. Track your expenses every day for 2 weeks. Go on a jog and follow a workout routine for 2 weeks. We are creatures of habit, and we can build momentum in ourselves. So that's step number 1. Step number 2 is find out what it costs. If you're not sure, just give it an approximate value. How much is an education cost? How much is a home cost? How much is a vacation cost? And number 3, And this is an important one. It's the reason that a lot of us, myself included, have come up short in achieving our goals, is to set a realistic date of when you want to achieve your goal. Here's an example. You have $10,000 in the bank and you want a new Porsche that costs $100,000 and you want to get it in 3 years. But you're living at home, you're making $50 a week on allowances. Oh, I have bad news for you. You should have stayed in math class. It's just not going to work. The result is that we get disheartened because we set unrealistic expectations of ourselves. And then we fall short of those unrealistic expectations. And so then we fall into a negative feedback cycle where we think we're not good enough or we don't deserve to achieve our goals. Subconsciously, we feel inadequate, we feel unworthy, and that anything more than just basic survival is unrealistic. Well, in that situation, we've given up on ourselves before we've even had a chance to start. But here's the good news. Planning is 95% of what goes on in the world of investment finance. The remaining 5% is luck. Here at Sophia, we don't just start randomly creating portfolios with no objective. We don't buy random stocks hoping that it'll work out. Setting a timeline is important to give ourselves a scale of how fast we have to move and how long we have to achieve it. So going back to that example with a Porsche, if your goal is to have a Porsche, we can still achieve it. Just extend the timeline by delaying gratification by a few more years. Or if your goal is just to simply have a car, we can just change the kind of car that we want. In financial planning, we pick different investment strategies for different goals, and each goal will have a very different timeline and cost to achieve it. Failing our goals, well, it comes from setting unrealistic expectations and using unrealistic strategies. But if our goals and our strategies are in sync, we can move on to the next question. Now, we've talked about managing your cash flow and we understand how to calculate our net worth. We've established a cash reserve for ourselves, and now we've set goals with realistic timelines to achieve them. Our next question is, how do we get there? So our talk isn't about the latest cryptocurrency to buy, and it's not about the next hot stock tip. This part is about understanding how to invest. Now, information in the financial markets moves incredibly fast. High-frequency trading companies invest millions of dollars in the hardware and internet systems just for a millisecond advantage on price. Now, if you don't believe me, well, in 2020, Google announced that it was building an undersea fiber optic cable to connect the US to Britain and Spain. And the purpose of this mega engineering feat and millions of dollars in costs, one is to allow computers to complete financial transactions milliseconds faster than their competitors. Finance is now increasingly dominated by automatic trading strategies, and to a computer, 5 milliseconds is an eternity. Last year, COVID-19 was announced on the last day of 2019. 3 months later, the financial markets dropped 30 to 35%. Company-specific news is digested almost instantaneously by financial analysts that do nothing else but spend their entire careers focusing on that company. Now, my intention isn't to dissuade you from managing your investments yourself. But unless you have a personal passion for portfolio management, it is simply not worth the time to manage it yourself. There are products that are available to you that can provide active management to reduce risk, increase returns, and save you time. But before we get there, let's talk about risk. And of course, here is another question. What do you think about when you hear the word risk? Do you think about A, danger, B, loss, C, fear, D, all of the above, or E, volatility? Go ahead and pop it down in the chat. You know, I'm just waiting. Lily selected E. Perfect. A couple of B's, a couple of losses and volatility. Furs picked A, B, and C. Danger, loss, and fear. And Sandra, you've picked loss. Well, risk is one of the most misused words in the financial world. Now, you and I in our day-to-day life understand risk as danger and tremendous loss. For example, what's the risk of getting hit by a car? What's the risk of meeting with friends indoors with COVID-19 going around? What's the risk of betting $100 in blackjack? In daily use, I absolutely agree with you. Risk means absolute loss and danger in our day-to-day lives. In finance, it is actually a measure of volatility about the expected return of an investment. It is not the measure of a possibility that an investment will become worthless. Risk is just the variance of the mean. It's how different a portfolio's expected returns are from the benchmark or an average. Matching your emotional capacity for tolerating risk or volatility is an important step to reach your goals, and it is the fundamental step in developing appropriate investment strategies. By the way, the answer in our financial world, E, is absolutely correct. Now, let's talk about the types of assets and the difference between active and passive management. These are your types of assets. There are 5 types for our purposes. Number 1, cash. This is just straight cash in your portfolio to fund opportunities, and it's important to have as a base for building your portfolio. Number 2, bonds. A bond is a debt issued by governments or corporations. When you buy a bond, you're lending your money for a set period of time, anywhere between 1 month to 30 years, and in return, you get some sort of return and your money back when the bond matures. It's important to look for high quality companies to lend to. Number 3, stocks. A stock represents ownership in a company. Historically, stocks have had the most volatility and higher returns compared to cash and bonds. Number 4, ETFs, also called exchange traded funds, are a basket of stocks, bonds, or both. You can buy a small ownership of this basket. Now, ETFs are passive, which means that they don't have the benefit of a manager overseeing the portfolio, which also means that they're cheaper. When the markets go up, ETFs rise with them, but when the markets fall, the ETFs fall just as much. Number 5, let's talk about mutual funds. Just like an ETF, a mutual fund is a basket of stocks or bonds or both, except there's a team of people managing the stocks and bonds based on investment strategies. These will have higher fees than the ETFs because of the active management. If you're looking for a mutual fund, you want to look for the best managers that will outperform the markets during growth periods and will lose less than the markets during market pullbacks. Companies like Morningstar, you can just go to Morningstar or Google Morningstar, will provide ratings on the best managers. I highly recommend that if you're just starting out and have under $100,000 to invest, use mutual funds until you become a more experienced investor. So those are the 5 broad categories of assets. Let's talk about asset allocation and diversification. Both of these are very important concepts when it comes to investing. Asset allocation is how you divide your assets. Now, I've seen portfolios with 100% bonds, and I've seen portfolios with 100% stocks. The more stocks that you have in a portfolio, the more financial volatility there is. The more bonds that you have in a portfolio, the less volatility there is, but that does not mean no risk. Risk, of course, means volatility. That doesn't mean no risk. So understanding yourself and your emotional ability to handle volatility is critical to building a portfolio that works for you. When I first started investing my own money, I bought 3 companies. I bought Amazon, I bought Spotify, and I bought the Royal Bank of Canada. I was so new, I was buying and selling the same stock in a matter of weeks. Now, there's nothing wrong with trading that often, except that every time that you trade, you're charged a trading fee of about $8 to $16. When I got nervous, I sold, and when I got excited, I bought. And at one point, I was counting how much hair Jeff Bezos had left on his bald billionaire head, and I used that as a gauge to how stressed he was, and therefore how Amazon was performing as a stock. He eventually went bald, and I took that as an indication to sell. But if I had actually just regulated my emotions, I could have left my money in there, in Amazon, and today I'd be living on an island in the Bahamas. Now, diversification is among the most important concepts to understand in investing. If you've ever heard the phrase, don't put all your eggs in one basket, what they really mean is to diversify your assets. For example, if you have $100 to spend on candy, it would be a poor strategy just to go spend it all in chocolate. You want variety so that when you're tired of chocolate, you've got other things like gummy bears or sugar canes. Diversification protects you. And diversification also applies in geography. Geographic diversification, investing in different countries, is important because when one country is not doing well, the others are there to pick up the slack. So I know it's a lot to take in, and now we've talked about the kinds of assets we can buy. Let's talk about where we can hold them. Asset location, different from asset allocation. Now, some of you might have heard of TFSAs and RRSPs and RESPs and never really understand them. They are complex. So let's just go ahead and get into it. A TFSA stands for a tax-free savings account. In Canada, if you're 18 and older and you have a valid SIN number, you are able to open a TFSA. You will never pay taxes on the growth in this account ever. This is the single greatest account to put high growing investments because it is literally tax-free. A RRSP is a registered retirement savings plan. And this is a little tricky, and I won't be getting into the tax laws. The general idea is that you want to use your RRSP in high earning years because it reduces your taxes. And when you're retired and you're not working anymore, which means that you don't have employment income, you can withdraw the money from your RRSP and have it taxed at a lower rate. Everyone has a different financial situation, but that's generally how an RRSP works. Now, an RESP is a registered education savings plan, and this account is used strictly for education purposes only. The government will match your contributions to a certain limit. And when you take money out of the account, imagine if you're a parent, you open one of these up for your kid. When you take money out of the account to pay for education, the money is taxed to the student, which is usually at a lower tax rate than the parent. And then, of course, there's also a non-registered account. This account has no special tax treatments, but there is nothing at all wrong with this account. So now we've understood our cash flow, we've understood our net worth, we know what our cash reserves are, we've set goals with reasonable timelines. We can now understand asset class and asset location and diversification. I know it's a lot to take in. We can now move on to our final question. And congratulations for making it this far. Number 5, how do I stay on track? If there is certainty in life, and I wonder if all of you can relate to this, if there's certainty in life, it's change. You might be headed to university, You might have graduated and started a new job. You might have gotten a new promotion, or you might even have lost your job because of COVID-19. Life happens, and we have to make sure that we can adapt and match our goals. It's important for you to review your portfolios on a regular basis. Some people check their accounts daily, but honestly, I wouldn't recommend it, because I think it leads to the single greatest mistake, which is when you're watching these numbers go up and down and up and down, it just builds anxiety in yourself. And that's when people panic and sell their investments during market lows. It's almost like weighing yourself 4 times a day to see if you're losing weight. It just doesn't add up. Finally, what should you worry about and what shouldn't you worry about? Focus on what you can control instead of what you can't control. You can't control what happens in the financial markets. We always say that 70% of the time, the markets will be up. 30% of the time, the markets will be down. And somehow it always works out that as soon as you put your money into the markets, the universe will test you with a market drop. But this concept of focusing on what you can control instead of what you can't doesn't apply just to finances. I know, and just from a personal level, I know that this year has been hard for me. I know it's been hard for you, and it's been hard on people in my family. You've had to deal with so much change just because of the pandemic. And a lot of us are restricted from even seeing our own families just to keep them safe. It's been hard, and there are so many limitations put on us, and it's easy to feel helpless and feel like a victim. Well, we can't control what's going on in the world, but we can control what's going on in our world. If you're struggling, if the isolation is getting tough for you, reach out to a friend and talk to them over the phone. The chances are they might need to hear you more than you needed to hear them. Now, the reason that we want to take control of our financial lives is because we become empowered. And when you're empowered, you're now in a position where you can empower other people. Well, we're getting to the end of my part of this presentation. I hope I left you feeling empowered and confident, and I hope you leave this presentation feeling stronger and more confident. And I'd like to just take a moment to thank Kamal Basra and Tracy Themes for their inspirations and support and guidance in creating this platform, Sophia Wealth Academy, and this presentation. Without them, this literally just wouldn't be possible at all. And also a huge thank you to the amazing people at Sophia Wealth Academy. Again, you wouldn't just do incredible work over here. And finally, I just love to give credit. If you've loved what I've talked about today, if it really resonated with you, and if you want to get a deeper dive, this book, The Financially Empowered Woman by Tracy Themes, is so filled with great information. And guys, it doesn't just apply to women. There's a lot that we can take away from here. Thank you very much.
Thanks, Philip. And now we've already got some great questions that are in our Q&A, so I'll get to those in just a minute. I'd like just to remind everyone that our next Wise Money Talks webinar is on Wednesday, May 12th from 6 to 7:15 with Kamal Basra from Sophia Financial Group. Join us then as Kamal will be presenting an engaging and informative webinar on how to achieve an empowered retirement, which might be a little bit soon for this crowd, but what I've learned is that it's never too soon to start for retirement. So it might be a really good seminar for a lot of people to join us with. She'll be walking us through the process of learning how to make our money work for us when we retire. If you would like to be part of that session, you will need to register on the Sophia Wealth Academy website. And as always, all of our Wise Money Talk webinars are free. We are also excited to let you know that we have been able to extend the 50% discount on our Financial Empowerment Foundation's e-course until the end of May. This interactive and informative course teaches the basics of personal financial planning through the lens of your own values, economic needs, and priorities. This will provide you with a deeper dive into better managing your own finances and is also based on Tracy's book that Philip just mentioned. And it kind of goes through those 5 stages in a much more deeper, but not too extensive way. So it's definitely worth having a look if you're really wanting to get a handle on your finances. To access this discount when signing up for the e-course, use our Wise Money Talks coupon code WMT2021. Please note that when registering, you will be charged in US dollars. All right, so now we're going to get back to our questions. And, oh, sorry, my video was off. I thought it was on the whole time. Sorry about that. All right, so diving into the questions. I have a question from Lily. I hear sometimes that there are strategies that improve credit when it comes to credit cards, paying half the debt early and then paying the rest on time or such a thing. Is there any truth to that? More specifically, are there any tricks to earning credit other than the obvious paying on time?
You know what? I think the person that's best suited to answer this is Tracy Themes herself. Tracy, do you think you can jump in here?
Do you know? You know what? I actually am not the person. I have with me sitting here the head of credit for Van City Investment Bank. So I'm going to put him on. Here you go. This is my husband, Gary Bindler. I know we're all family here, so he credit. Financial advisors don't deal with it. So,
Gary, do you want the question again?
Sure.
Okay. I hear sometimes that there are strategies that improve credit when it comes to credit cards, paying half the debt early and then paying the rest on time or such a thing. Is there any truth to that? More specifically, are there any tricks to earning credit other than obvious paying on time?
I don't think on the repayment side, other than meeting your obligations, particularly triggers a higher credit score, which I think is what you're looking to do here. The big thing to watch is that you don't overuse credit or seek more credit than your capacity would allow. That will hurt your score more. So that's really the quickest answer I can give you.
Great. Thank you, Gary, for popping into our Wise Money Talks seminar. There we go. We had a guest visit. All right. We have another question from Lily. Can you make a registered education savings plan for yourself, or is it typically something you do for another person or like a child?
It's typically what you do for another person or a child. So as soon as your beautiful baby comes in the world, you can open an RRSP. Yeah.
Okay. And then another question that came up is when someone is at the point where they've got their cash reserve, you know, they're managing their debt, but they're ready to start investing. Where should they start? Should they go to the bank? Should they find a financial advisor? Like, what's a good place to start, and what should they look at RRSPs at an early age?
Yeah. You know, the latest trend in investing, and I'm sure we've all seen the ads for these, are robo advisors. It's a great start for new investors because if you only have a couple of $1,000s, and in this situation, maybe you're paying off your debt and now you just have a little bit of surplus, they actually have really sophisticated investment strategies and smooth platforms that can help someone just starting out get into the market. I think as your net worth and your assets grow, you'll have more complicated situations that a program won't be able to understand. For example, like, what are your goals? What are your priorities? What's your tax situation and what's important to you? In this situation, that's where a financial advisor would be able to provide great value. But if you're just starting out, I think you could be able to quite reasonably find great success with a robo-advisor.
So not go to the bank then?
I'm going to jump in too, Phil. I agree with that answer. And it's the banks, the major banks have very sophisticated portfolio managers and typically quite reasonable fees. So that's not a bad option. You typically have to have $1,000 or $2,000. Another place that at Sophia Financial Group we send people, but My understanding is their minimum has been raised to 10,000 as steady hand investments. That's another local financial advisory firm that has been successfully democratizing access to high-level management. So I agree with Phil, the robo-advisor situation when you're just getting started because of the algorithms. But if you want a little bit more personal, well, it's hard to say that a bank is personal, but you actually want to go in and talk to somebody or go online, a mutual fund specialist at one of the major banks or credit unions is also a good shot for you.
Great. Well, thanks, Tracy and Philip. We're getting lots of great input tonight. What do you think is the #1 mistake that new investors make, Philip?
I think new investors are, and there's nothing wrong with being a new investor. You're gaining experience. I think new investors aren't equipped to manage their emotions. So just like how in my presentation I talked about when I was starting out, I was buying Amazon and was buying and selling without any actual fundamental news. I think new investors are likely to let their emotions drive their decisions, because emotions are such a powerful force in ourselves. And in some situations, emotions can help us, but in other situations, emotions can hurt us. That's why creating a goal and coming up with a strategy and sticking to it is almost the only way that we can build wealth, short of winning the lottery. I think new investors are more prone or more likely to buy high and sell low, which is exactly the opposite of what investing is all about.
Right. So it's about the long game.
That's
Yeah.
right.
Now here's a question that would not have occurred to me, given I'm not in the age group, but should they be looking at buying Bitcoin right now?
He knew he was going to get that question.
My general opinion about cryptocurrencies is that at the moment they are very high risk. If you have to invest into cryptocurrencies like Bitcoin, only invest what you're willing to lose. Just on a personal note, the basis of a cryptocurrency is that eventually we'll be able to use it for our daily transactions. But I don't see
savings plan for students to self-track their spending.
Oops, sorry.
So we'll get to that question in a minute. Sorry, Philip, you go ahead. I'll get to that question in a minute.
Yeah, so the basis of cryptocurrencies is that they want to replace traditional currencies. You'd be able to go to a store and buy a jug of milk with a share of Bitcoin. But I don't think governments will want to adopt it because they don't have any control of it. I see it instead as a possible store of value, but again, only invest what you're willing to lose. I wouldn't recommend it as a core holding in your portfolio for your long-term strategy.
Great. Well, thank you for that. And then Marissa's also wondering if you have any advice on the best bank savings plan for students to self-track their own spending.
I think maybe Tracy, did you have an input on that?
Excuse me.
I don't know if you heard, my speaker was on and I was asking my Van City person here. I think if the question is, are there self-tracking mechanisms with some of the banks? Yes, there are. I have seen them with RBC and TD, which are the two that I'm most familiar with. Which are the best? I don't know, but Phil, you were researching that. You were looking at things like Mint, and what was the other one?
Yeah.
You need a budget.
The other one, I use the RBC banking app. They actually have a program called NOMI, NOMI, which is just automatically installed into your RBC banking app.
Okay.
And it can just give you metrics on your spending. Like this month you spent you spent $100 more than you usually would have on groceries or going out with transportation.
Okay.
So it's incredibly useful.
Great.
Well, thank you. And thank you, Tracy, for popping in. And
I'm popping in.
Yeah. And so that's the end of the questions that have come in, Philip. And so I just wanted to thank you again for such an informative and fun perspective to financial planning. I learned a lot, especially around flexing and realizing it doesn't just affect young people. Like, I think we're all affected by that. I think, we get caught up in what we think everybody else is doing. And And sometimes it's just good to have that dose of reality. And then I think I also knew some of the people in your slides. I think maybe half. But anyways, but once the session has ended, I just want to remind people that you're going to be asked to do a quick survey. Basically, it'll take less than a minute to do. And your feedback is really important to us as it helps us design other upcoming sessions as we move forward. We would also invite you to check out our Sophia Wealth Academy website. We have a new blog feature, and you can find out more about other upcoming events through our Wise Money Talk series and our Wise Money Moves podcast, as well as other resources like the downloadable spreadsheets that were in your chat section earlier. That also will be just a nice, easy way for you to keep track of what's coming in and what's going out, and also get a sense of your net worth. And those are free, so those are just great resources that you can access from the website. And we'd also like to invite you to help spread the word by sharing Sophia Wealth Academy upcoming events with friends and family. And then make sure that you're following us on all of our social channels, as we have some exciting giveaways coming up over the next few months and have something really special planned for Mother's Day. So stay tuned. And again, I just really want to thank Philip for taking the time today and having such a fun and engaging workshop. And you made me laugh. I was cracking up here when I thought that my sound was off because there was something, and I just thought you just had a wonderful way of making this all really accessible. And we look forward to having this available on our YouTube channel and that we can access at any point. So again, thank you. And just want to wish everybody a good night.
Thank you very much. Thanks, everyone. Have a great night.
All right. Thanks.